I think feel free to take your seats. I'm gonna let Kapil kind of introduce us.
Yeah, awesome. Yeah, like Sumit said, thank you so much for everyone who's coming, virtually or in person. For all of you, thank you so much for joining us virtually. For the guys who came in person, really, really appreciate it. We're super excited. We've been looking forward to this event for a long time. We just to talk to all of you. I'm sure all of you are reading a lot about real estate in the news with interest rates, with the way the market is changing. We have a few potential investors in the room, first home buyers, a few people we've worked with in the past. So there's knowledge, there's new knowledge we hope to share with each and every one of you. And right at the end, we're going to have a few questions and answers. Anything you kind of want to chat about, by all means, we'll be happy to chat about that. So with that said, I guess we'll get started. For the people online, for any reason, if you can't hear us, please let us know. We'll try to work on the next time at the same time. But I think based on what I was testing, it should be good. Okay. So first off, just a little bit about me. My name is Kapil Ramchandani. I work with Sankey 21 H. That's actually the office we're in right now. And I think something I really just want to share about myself, I want to drive home right now where there's a lot of realtors in the market. Something just about me. I focus on being clients. I know that sounds generic. I know a lot of agents would say that, but I've now worked with first-time home buyers, investors. I work with users, we're flipping houses, and for each and every one of them, the entire process has to be different. For each and every one of them, their priorities are different, and it only makes sense that you have to gear yourself towards what they need. I think back in 2020, a lot of people who've kind of been in Canada will remember that there was a time where you could list a house within a week, it would sell. There was really not much that had to be done. But now we're coming to a point where it's really important to work with the realtor who understands the market, understands what you need, and finds where that ground can really match. And that's what we want to focus on. And that's really something special about me. And on top of that, my brokerage, we we have almost over 350 agents, 500 if you count a few who are inactive, and all of us are focused on providing you guys the highest quality of service. We have offices spread across Vaughan, Richmond Hill, North York, Toronto, and from each and every kind of market that you may be looking to get into, we're here to serve you and here to help. So yeah, that's a bit about me.
Thank you so much, Kapil. For those of you that don't know me, my name is Saram Hassan, and I've been a licensed mortgage agent with PLC for the last 4 years now. I've been working with Affinity for all of it. And throughout my journey in this, I've come across a lot of challenging deals. I've come across a lot of situations which have genuinely come to my eyes. So what can be achieved, right? I've also been underwriting for a lot of years. Basically means that whoever is not comfortable enough to submit a deal by themselves or speak to lenders, I kind of do that for them from front to back. I've also worked with a large variety of I know you guys have a lot of questions as well. And my answer to question, our goal as mortgage agents is to kind of educate you guys the best way. So we're looking forward to this, and yeah, let's keep it rolling.
Hey guys, my name is Sumit Sundar. I'm the director at Infinity Mortgage Solutions. Family-owned company. We've been in the business since 2018. Myself, I've been a mortgage advisor since 2014. So about a decade, I started off years, and then that part of Infinity. Very proud of. We have probably one of the best books in the GTA, of value five. Definitely deals. So we have a wealth of knowledge, wealth of experience, and we're looking forward to that. Okay. That's a bit about myself.
So I've been in the legal field for about 10 years. Got my degree in law, and then I went to law school in University of Ottawa. After law school, I did my marketing where I worked for Nick Hunter, and then I worked for a small firm where I did family law and real estate law, and now I'm a main broker. And I'm going to walk you through the process of having a home.
Awesome. So that's a little bit about all of us. So Now I think we'll just get into right into the meat of it. What is going on with Ontario's housing market? I think all of us may have questions, but I think we just want to start with the numbers. We want to start with how the market is behaving. So you've probably been reading a lot about it in the news, but let's look at how the market is performing on an average. So first off, let's talk about sales numbers, residential listings versus actual sales that are happening. Sure, this is a graph, but the way I'd like all of you to interpret this, not really the actual points that are on this graph, but read the general trend. We saw a point where there was a surge in listings that came up. We saw a point where sales began going down. We saw a point where sales began going up, and then sales come down. How do you interpret this? Well, essentially around November to December of last year, Sarv and I had actually hosted a webinar. And at that time, we were just about midway through this graph. And we saw this point where listings were going down and sales were going kind of steady. And we said, well, people are getting comfortable with interest rates. People are trying to understand what they can get from the market, are more practical about what's possible in terms of cash flow, in terms of investing. Of course, then Bank of Canada goes ahead and hits us with a few other rate hikes. As those rate hikes come in, once again, we see the sales going down and residential listings going up. What that means is the demand for the market was always there. There were people who were looking to get into the market, who were looking for the deals. Interest rates went up, and that kind of pushed them to come right out of the market. When interest rates come down, which they will, the economy has to improve. When that will is a whole other million-dollar question. But when they do, that demand in the market is there. That demand for owning your own home, for expanding your investment portfolio, that demand has not gone away. It's simply paused. And all those people are waiting for the right opportunities. And so do you want to be one of the people who comes in when all these people surge in at once and, have to get the best deal while you're fighting with 20 other competitive offers? Or do you want to be the person who buys when rates are higher, assuming affordability, assuming cash flow still works out, but you benefit in the long run when you're the one who was smart enough to act earlier? So that's really something I think I want to push forward this whole presentation. And now in terms of actual numbers, in terms of the price you're paying for. So you see 4 lines in the graph. The orange one right in the middle is your average price for home. And what we've seen is that, sure, home prices back in 2022, which is where this starts, January 2022 till present time, home prices were averaging about 1.3 and came down to about 1.05, 1.1, and now averaging up to 1.15. And what you may read in the news, I was reading this like a week ago or so. They were talking about how month over month, home prices then began going up again. So does that mean real estate is rebounding? But I want you to take a minute to think of this as a as a way to really understand what an average really means. Because when we talk about average price, it really is just that. It's an average. When you look at the average detached home prices, those have gone down considerably. And people who are looking at detached homes are now able to say that, okay, yes, interests are higher, but we are getting a better price and are able to get into the market. And as detached home price sales go up, the average price that you are seeing in the market also tends to go up. And that's actually what you saw last month. The number of detached home sales had gone up. And that's really what that average represents. What I think is really important to take away from this graph, though, is in terms of detached homes, they've gone down from a high of 1.7, 1.8, averaging 1.2 now. And condos starting at 850 are going down to about 750. Both have seen a decrease. Both represent the fact that there has been a market correction. Further market correction is expected, but there's already been a significant change in the market, and this is going to continue. What's really important, though, is if we talk about something like the Junction Triangle, Etobicoke, that kind of area has seen almost a 30% increase in price compared to 2022 to 2023. If we talk about Little Italy or the Bay Corridor, that's seen about a 25% decrease in price. And if we talk about Peel Region or Durham, that's seen about a 0% change in price from 2022 to 2023. What does that mean? Each area, each type of home is different. And it's very important to use the data to your advantage and work with a realtor who understands that. You can't just use an average price to justify that this is the right time to buy. You have to look at where you're buying, what the price point is in that area, how the data has been performing, and what kind of home will give you the best outcome. So it's really important to consider all of that. So really important to keep that in mind. What I really want to drive home as well is what you see in the news as well now is that we're officially in a buyer's market. What that means is as buyers, you guys now have the power. We are now seeing longer times in terms of deal closing. We're seeing properties stay on the market for longer. Sellers are getting more desperate. We're seeing inspection clauses come back, condition of financing being extended. Me and Sarv actually worked on a deal just closed about 2 weeks ago. We didn't ask for 5 days, which is the normal condition of financing time. We asked for 10 days. And we are able to do that because we provided the strong offer. The sellers were interested in selling, and we were able to use that extra time to our advantage. And Sarah was able to do a great job at finding the best lender for my clients. We were able to shop around a lot more. That means it's your chance as buyers to really take advantage of the whole situation. And sure, yes, there's a lot of unpredictability. There's a lot going on in the market. But what you know about real estate is that it's cyclical. We know the market will stabilize. There will be improvement. Maybe a year, maybe 3 years, maybe 10 years. But as all real estate gurus, anyone who's been in the market for more than 2 or 3 years, who didn't get in the pandemic era, will tell you that you don't wait to buy real estate. Buy real estate, and then you wait. And it's a long-term game. When you're talking about a long-term game, it's really important to keep that in mind, that market will improve over time. You will eventually find stability. And when that stability comes in and you have a consistent growth, that's really when you'll see the upside. And at this point, I know we talk about a lot about numbers. We talk about how we have to look at properties as though we're going to be flipping them. We're going to be moving a lot. It's really important to remember why we actually buy a property for most of us to begin with, especially people who are joining online. From what I understand, a lot of you guys are first-time home buyers. And that's exactly what we're talking about. We're talking about your future home. There's a lot of emotional value attached to this purchase. It's not just an investment. It's not something you want to hold on to and scrap away. It's something that means a lot to you and your family. And so you have to keep in mind that it may not be something that's perfect right now, but in the long term, it will pay off. In the short term, you're able to achieve the goals, the smaller goals that matter a lot in the long run, right? It's all about the fact that you can build equity over time. This is just another way to save money, and that's really, really important. And it doesn't take away from the fact that when you buy a first home, you now have that sense of ownership. You have that freedom you can get, right, that you don't get from renting a property. And something else I just want to share, you kind of hear about more and more people talking about this in the States, but it's more relevant than ever now when you're talking about buying a home at 6%. You have to date the rate and you marry the house. The rate is going to be temporary. It may be something that changes in a year or 2 years, but the house is something that's going to stay with you, stay in your portfolio for a long time. And when you think of that relationship in that way, you really get the sense of what that emotional value is. So appreciation, we talk about property value. Why are people so optimistic about appreciation? Why do we think that the market is going to improve? So the reason is actually threefold. The first reason is immigration. Immigration is at an all-time high. People are coming. We are inviting people to our country, and they are coming because there's such a good demand. But you'll tell me, hey, Capital, what happens if immigration changes tomorrow? What happens if the immigration minister says, you know what, no more immigrants coming in whatsoever? What happens then? Well, it doesn't change the fact that we already have invited a large number of immigrants. That demand for home ownership hasn't gone away. Those graphs we saw where interest rates changing allowed home prices and home sales to change, that doesn't go away. Those people are still in the country. That demand is still here. That's local. That's present. And so that doesn't change. And that's why the optimism is still in the market. The additional immigrants are just going to add to that. A lot of them will come with high-paying jobs. A lot of them will come with a good amount of wealth coming from other countries, and they're able to add to our economy that way. The second reason is this idea of community spirit. A large part of Canada, a lot of communities are built on community spirit, and a lot of smaller communities like Kitchener, like Vaughan, like King City, like Pickering, as they develop and that community spirit grows, we're expecting populations to move there and that appreciation to help us out. And the third reason is the fact that in general, we talk about investments changing over time, we talk about economic development. In general, for Canada, is fairly optimistic for the long run. And that's what really plays into our favor. Yeah, so I want to touch on this very briefly. I was talking to you guys earlier about this idea of pre-construction versus resale. We could talk about this for an hour or two, and it wouldn't stop. It would just go on and on and on. For the guys in person, you can see we have some pre-con projects up at our brokerage anyway, because there are so many projects going on in the GTA. In September alone, there was over 40 projects that were launched. That is crazy. And that demand for pre-construction, the demand for home ownership is what's fueling that. The biggest difference in pre-construction is the time, the fact that with resale, you'll own a home in the next few months, whereas for pre-construction, you now have up to 7 years or 8 years that you have to arrange for financing. And right now, a lot of builders are offering incentives such as you pay 5% this year, and that's it, 5% next year, and then 5% on closing. That's a huge difference. For some of you guys who've been in Canada longer, will remember that. Go back maybe 7, 8 years ago, it was 20% in the next 12 months, and you have to pay your entire deposit. All that's changing. Now they're trying to be a lot more accommodating to people who are coming to the market as investors or first-time home buyers who don't have the cash ready, but are going to have it ready in the coming years when the market improves. Why I use a realtor? Okay, so I shared a lot of information with you. I shared data with you. I shared emotions with you. But why even work with a realtor? You could just find all of this out of articles. A realtor is able to take all this information, funnel it down for you, make it relevant to you. And it's what I started with at the beginning. My whole focus is being client driven. I want to make sure I understand your situation. Most clients I work with, I start off just by taking them for coffee, sitting down and chatting with them about exactly what they're looking for, whether you're investors or first-time home buyers, figuring out what your criteria is, and then working to make sure you can get that. Setting your expectations right. All of that is very important. And that's where it really matters to work with a realtor, and more importantly, a good realtor. Okay, so now really to get into the crux of why a lot of you are here. What does it mean to, and what is the process of purchasing a home in today's market in 2023? And I think what you're going to find is between me, the mortgage guys, and the lawyer, as we go through this, we're going to have a lot more tips and a lot more information about each of these steps. I'm going to start kind of high level based on how a realtor gets involved. So what I'd like to say is, and I break this down the same way for all of my clients, especially first-time home buyers, all you need to buy a home is a plan. And where that starts is first, you need to get pre-qualified. You need to start working with your mortgage agents, get pre-qualified, figure out what your budget is. You have to include stuff like your down payment. You have to talk about your deposit. You have to talk about, no worries. You have to talk about your, I totally blanked that. Your closing costs. Sorry, you talk about your closing costs. And all these things play an important role in what you're finally going to pay. So it's really important to figure that out at the beginning. The second step is the fun part. It's where you learn more about yourself and more about the market. This is really what I enjoy the most about this job. It's where we get to check out houses. We figured out your budget. We get to see what works for you, go to different pre-launch events, go to different homes for viewing. I love it. Each home has something different. If you guys are ever bored and just want to check out properties for fun, by all means, give me a call. I'm always ready to do that because you always learn something new. You have no idea how creative homeowners have been with the way they change their home and make it more personalized. So this is the fun part. You really get to figure out what works for you and explore. You have to consider the communities that matter to you, to consider the type of home that matters to you. Is it a condo, a townhouse, or detached? And you may be able to find certain areas where townhouses are in your budget, and in other areas, condos are in your budget, and other areas, detached homes are in your budget. So all of that plays an important role to what you're looking for. When we finally find the right thing, we submit an offer. This is where your offer gets accepted. Nice and easy, right? Super simple. You submit an offer and you're done. Unfortunately, it isn't that simple. But when you work with a good realtor, when you work with a good team, it can feel that simple. A lot of my clients, we submit multiple offers before we finally land that perfect home where offer gets accepted. But it's really important to remember that when your offer finally gets accepted, you've landed something great. That's for sure. And now you begin working on all of your conditions, your condition of financing, inspection, working with your lawyer. And it's really important to make sure all those things are done in a timely order. And again, where realtors can be very helpful, they'll make sure everything is done in a timely manner. And enjoy your new property. You finally moved into your new home or your new investment. You may be working with getting new tenants in, but now you get to enjoy the beautiful new place you have. So yeah, so that's what it was for me. I hope I broke it down well in terms of what a plan is. And now I'll pass it on to Subin and Saurav to break down the mortgage side of things. I think for the online folks, we're just going to ask to hold our phones.
For sure, yeah. Definitely, yeah. Perfect. So this is another one of the questions that are always asked to us, right? Why should I use you guys and not go to a bank or not go to a branch? And there are factors for this too. I mean, it's just the fact that we work with a variety of lenders, and we have a variety of products and variety of rates that we can actually offer you, right? So for example, if you come to me and say that, for example, Scotiabank rejected your application. Now, my first thing is going to be, we don't work with just Scotiabank. We also work with other banks as well. HSBC, for example, TD, for example, right? If your deal cannot be worked out at one particular lender, doesn't mean that another lender would not be accepting it as well, right? So, and it's not just banks. We also have access to B lenders. We also have access to private lenders, right? So whatever your situation may be, like I said before, whatever situation may be, there's always going to be some sort of solution that we can try our best to present for you. And I'm sure that Subin can actually attest to that fact as well.
Yeah, absolutely. You know, we work with about 60 plus lenders, guys. Of those 60 plus, I would say 8 to 10 we work with very closely. Now, the big banks that we do not have access to currently are RBC, CIBC, and BMO, which are all slowly starting to come into the fold of a broker channel. So We will eventually have access to them, but we've got TD, as far as I said, we've got Scotiabank, we've got HSBC, soon to be National Bank, and then of course a plethora of B lenders that we have as well. Those alternative lenders also offer Schedule A rates. So just because someone presents you, with a commitment from an equitable bank or a home trust company, those banks' rates might actually be better than what you're getting from a CIBC or an RBC that you're accustomed to, right? So very important to understand that. We have options, and we're not just going to funnel you into one category and say, hey, this is where it works and this is all it can be. We'll shop it around for you and we'll tell you exactly where you fit, where the best deal is based on your specific scenario, right? That's what we're about. So that's why give us a competitive advantage versus you going to a CIBC where they can only give you a CIBC product, or an RBC where they can only sell you on an RBC first time buyer or special program. We have a bunch of special programs. Of course, that's for us to let you know about, but we do have those options for anybody and everyone across the board. Okay.
Perfect. So before we even start off with our section, I know that a lot of the terms that we actually talk about may be a little bit confusing for you guys. So let's just start off with some basic terminology, right? Starting off with obviously interest rates. This is probably the most self-explanatory one. It's just the cost of borrowing money paid to the lender. And as of today, the interest rates, variable as well as fixed, which we're going to be getting to, are definitely higher than they were a couple of years ago during the pandemic. And we're going to be getting into that as well. Even a fixed rate versus a variable rate. Now, fixed rates are basically rates that throughout the term of your mortgage, they will not change no matter what. For example, if you secure a fixed rate today of about 5.5%, just as an example, for the next 3 years, till 2026, the rate is not going to change. It's going to stay fixed in place until your renewal time actually comes. As for the variable rate, though, the variable rates are actually affected by the overnight lending rate of the Bank of Canada, as well as the prime rate. So the prime rate as of today is 7.2%. Now, if any of you guys know somebody that has a variable rate mortgage, you may see that it will say like prime minus 0.9%, for example. All that means is that there is a discount of 0.9% to that prime rate. So their rate is 6.3%. For example, in the future now, if the prime rate was to go down to 6.5%, that discount is still going to stay in place. So your rate now is going to be 5.6% and vice versa. So with the prime rate going up and down, that's going to have the same effect on the rate that you have if you have a variable mortgage. Now, one important thing to note is you can always switch from a variable rate mortgage to a fixed rate mortgage, but you cannot do the opposite. So if you're stuck in a fixed rate, you're stuck. And also, if you ever have to break the mortgage at all, fixed rate mortgages, the penalty is actually dependent on the IRD, which is the interest rate differential. And that number is quite costly in a lot of cases. And your bank will have to calculate that for you. If it comes to a variable rate mortgage, all you have to pay is 3 months of interest penalties, and that's your entire penalty.
Yeah. Just a quick point on that as well is that when Swarav means you can switch from variable to fixed, if you wanted to lock in your variable rate, you'd get the fixed rate for the remainder of your term at the time of whatever that rate is on the market. So it's not as if you're going to be locking in for that same rate that you have. If you're on a 5.4-year variable rate and you've gone up to 5.6, 5.8, you're not getting 5.8 fixed. You're getting whatever the market rate is on the fixed product at that time for the remainder of the term of your mortgage. And, that can range anywhere from 1 all the way to 10-year terms. No one signs 10-year terms, obviously, but, that range is there. And then in regards to amortizations, of course, maximum of 30 years. So in this case, we just came out with a product where you can amortize your mortgage over 40 years, which is going to help with qualification drastically, right? Amortization is just the amount of time it will take you to pay off the loan on your specific mortgage. 30 years is a standard. 25 is if you're putting less than 20% of your purchase price down. Of course, it's an insured mortgage, which we'll get into as well. And then 40 years is a new term that they've introduced on the market exclusively for us. Because we work so closely with one of our lenders. Stay tuned for that. We'll definitely be dropping more information on that. But for the realtors in the room, that can definitely help your prospective buyers get qualified for a higher purchase price. Okay, something to keep note of. Penalties, I think Swarav, you already touched on that point, right? As to what that's going to be like. So we can go to the next slide. Okay.
Perfect. So when it comes to actual mortgage eligibility, you guys might be wondering, how does a mortgage agent actually qualify you for a mortgage? Why is it that some people can only get qualified for a $600,000 mortgage, but somebody else may qualify for 900,000, right? So now there's certain parameters that we have to look at. The two most important things for any mortgage, arguably, are a GDS and a TDS, which is a gross debt servicing ratio and a total debt servicing ratio. These things are going to be covered by Subin in detail in the coming slides, but the main pillars of a GDS and TDS calculation are going to be your income and your expenses. So when you first give me a call and say, Sarah, look, like I have this much down payment, can I qualify for a $700,000 property with, for example, a $560,000 mortgage? Can I qualify for a 560K mortgage? That's the main question. And what I'll be doing is I'll pull up my calculator, and the main thing that I'll be doing is going to be, going over four different things: your income, your expenses, all your liabilities, as well as your down payment, right? So when we start off with income, the first question always is, what do you do for a living, right? Because your income is definitely one of the most important things when it comes to getting a mortgage. So what is your family income? Is it just you on the title? Is it also your spouse? Is it also your kids? Are you a full-time employee, for example? Are you self-employed? Do you have a contract? Are you a seasonal worker? Do you get any pension income? Do you get any rental income? Do you receive any child tax benefit income, right? All of these incomes can actually be used by us to qualify your mortgage. Then when it actually comes to the expense side of things, this is where credit comes into play. For most lenders, as a rule of thumb, you want to make all of your payments on time, and you want to maintain a credit score of over 680 plus. But that is with most lenders. Like I mentioned, as mortgage brokers, we have access to hundreds of products. So I've even got mortgages done, and same with Subin as well, of people with credit scores in the 400s, right? That's definitely happened. And the rates are definitely higher in that case, but that does not mean that a mortgage is not present for those people, right? So credit is very important. As far as your liabilities are concerned, these are going to be all the liabilities that are present on your credit bureau. So when I do pull your bureau, whatever is present on there has to be sent to the lender. Any credit card loans, any car leases, car loans, any financing, any student loans, anything that is big and shows up on the bureau will be present on the application that I have to send to the lender as well. As far as liabilities go, that's that. And on top of that, we also have to take a look at all of your properties. So the expenses that are related to your properties, your utilities, your condo fees, your property tax, your mortgage payments as well. So now you guys may see a term there called a stress test. What that basically means is back in 2017, the government of Canada introduced this to basically see that if interest rates were to go up, would our borrowers still be able to make their mortgage payments? And they were right about that because interest rates did go up quite a lot. What this basically means is, at the moment, the stress test, the mortgage qualifying rate actually is 5.25%. What that means is if, whatever your contract rate is, back during the pandemic, the rates were about 1%, 2%. We've seen those days as well, right, Subin? Yeah, 0.99%, right? We've seen those rates as well. So it was either that rate plus 2% or 5.25%, whatever one is higher. We have to qualify you at that. So even if your rate was at 2%, I would not be qualifying you at 2%. I'd be qualifying you at 5.25%. Nowadays, though, rates start about 5.25%, right? So it's not going to be 5.25%. It's going to be your contract rate plus 2 because that is the higher rate in theory. So for example, if the rate you're getting right now is 6%, I have to qualify you not at 6%, but at 8% in that case. So that is also why qualifications have, become that much more difficult, because instead of qualifying people at 3% or, 5.25% like in the past, now we have to qualify you at 8%, 9%, 10%, which completely kills the qualification, right? Other factors that actually come into play as well are property value and appraisal. So we're going to be sending a certified licensed appraiser to your property in most cases to get a valuation of what your property is worth. So even if you qualify for a mortgage of $1 million, in most cases with conventional mortgages, you can go up till 80% loan to value, which basically means if you're buying a property worth $1 million, the max mortgage that you can actually qualify for is $800,000. So even if your qualification is 1.1 million, 1.2 million mortgage, I can only get you a mortgage of $800,000 on that 1 million property. Other thing, like Subin mentioned, is the mortgage amortization. 25 years and 30 years are the most popular terms. There's disadvantages and advantages to both. If you go with a 25-year, you're paying off your mortgage much faster, but your monthly payments are going to be higher as well. In that case, you're also going to be getting, in most cases, a lower interest rate. If you go with a 30-year AM or a 40-year AM, yes, you're paying off your mortgage over a more lengthy period of time, but your monthly mortgage payments are going to be lower, which increases your cash flow situation as well. And the mortgage qualifying rate, like I mentioned, 5.25%, but in today's market is mostly contract +2.
Yeah. And just a quick point for our online audience. I know you all have a lot of questions. We will get to those questions at the end of the session. Oh yeah, we can share the deck absolutely with everyone after the presentation as well, no problem. So we'll get to those questions. Just bear with us, and we'll get through this one, and we'll get to those as well. Now I think we're on the next slide. Yeah. Okay, so ratios. I guess we're going to be discussing GDS and TDS. Your gross debt servicing ratio, of course, is going to be your principal and interest payment on your mortgage, plus any property taxes associated with the property, heating, and 50% condominium fees if it is a condo, divided by your monthly income. Okay, very basic calculation. I know it's a lot of math here, guys. We'll do it for you, but again, this is kind of the basic calculation of how you can understand how to qualify for your gross debt service ratio. Okay, now your total debt service ratio is the exact same thing, but now we're factoring in your liabilities as well. So let's say you have a student loan that you have to pay on a monthly basis. We'll take that into consideration. An auto loan, car loan, okay? Any credit cards, any lines of credit that you might have are all going to be factored into the total debt service ratio, plus all the additional costs associated with the property you're buying divided by your monthly income. Now, the standard rule of thumb based on the industry is total gross debt service ratio of 39%. Okay, the total debt service ratio, we can go up to 44%. Now there's leeway there for both. So 39% meaning your liabilities weighted against your income should not exceed 39% of your total income. The total debt servicing ratio, it shouldn't exceed 44% of your total income. What we're seeing in the market right now is that most lenders are willing to push those ratios up to about 50-50 because the Bank of Canada prime rate is so damn high right now. Unfortunately, that's just the market we're in, right? So they're willing to push those ratios up a little bit for you. And we're here to help you get to that curve. But as far as the math goes with it, calculate how much debt you have, on a monthly basis. This doesn't include, your Netflix account or car insurance or your library card. So small things don't matter. What we're looking for is what's on your credit bureau, and that's typically going to be an auto loan. It's going to be your credit cards. It's going to be lines of credit. It's going to be student loans. So if you know what those monthly payments are, you can do this calculation yourself in terms of calculating, okay, this is how much I make on a monthly basis, and these are the debts that I have. If I were to qualify for a mortgage, how much could I qualify for? One thing that's not in the slides here today is that we do have something called the Canadian Mortgage app. I encourage everyone to download that. You can punch in the numbers yourselves and see how much you'd qualify for based on the interest rates. It's called the Canadian Mortgage app. It can be found in the App Store. Okay. Affordability. Oh, sorry.
Thank you. So just going back to GDS for just one quick second, just a little quick example for you guys. For example, if your monthly salary is $5,000 and your spouse's monthly salary gross is also $5,000, that brings your family income for the whole month to $10,000. In this case, with most insured files, like we mentioned, you cannot go past 39% GDS and 44% TDS, which basically means if your family income for the month is $10,000, your monthly housing costs cannot go past $3,900. $3,500 is actually there because one of the insurers, which is CMHC, has their ratios capped up at 35% GDS and 42% TDS. But the other two insurers that we do work with have ratios capped at 39% and 44%. If we look at TDS, for example, same exact thing, the income stays the same, which is $10,000. But in this case, we're looking at other expenses as well. So credit card payments, other monthly payments, auto payment, everything like that. And in that case, it cannot exceed $4,400, which is 44%. Now, these are just standard parameters set by insurer guidelines, right? Like we mentioned, and I'm going to keep hammering on this point, the fact that we work with so many lenders means that we are not limited to just these ratios. These ratios are limited for a few lenders and for all insured files.
But when we actually look at other lenders as well, we can go upwards of 60% GDS and TDS with a lot of lenders as well. So when it comes down to it, if you cannot qualify within these parameters, there's no need to worry because there are other lenders that can actually help you out and have a solution that's right there for you. So all you have to do is sit with your mortgage agent, sit with me or sit with Subin, tell us your situation, and based on, if you are debt averse or if you want higher amortization, lower amortization, whatever your situation may be, whatever your ratios may be, if it's a rental property, if it's an owner occupied property, we can give you the solutions that's tailored right to your exact needs.
Yeah. So just to keep it like bare bones, and I'll give you guys a quick example of what we're exactly talking about in terms of the affordability piece on GDS and TDS. Let's say and I'm not a real estate expert, but let's just say, for example, you're buying a condo for $500,000. Okay, 500,000. The minimum down payment you would be required to have on that $500,000 purchase is about 5%. I think that's like $25,000. So let's just start with a low number. If you have $25,000, you can get into your first property, right? Now, the affordability piece of it and working on the numbers, you leave that up to us. It's typically, if it's less than 20% down, it's going to be 5% on the first $500,000 and then 10% on the next 10 next remainder of the purchase. But that's kind of a technical term. I don't want to get too much into that, but just keep that as a baseline. If you have a property that's under 1 million on the purchase, you can get into it with 5% down. If it's above $1 million, you need an automatic 20% down. So as Swarav said, if you're purchasing $1 million property, you're going to need $200,000 versus if you're purchasing for $990, it's going to be substantially less because you can put down that 5%. We're talking about less than 100,000, right? So, make sure you gauge those factors when you're making your decision. But again, before you talk to a real estate expert, you're naturally going to come see us first. That's just the law of the land. You should be talking to your mortgage advisor to get pre-approved before you go and make a purchase with your realtor, right? So other costs associated with this type of with any home purchase, really, you're going to have your GST on a new construction property, which Amanda is going to touch on in a little bit. Of course, mortgage insurance premium, appraisal fees, lawyer fees, so on and so forth. Again, all of these are fees that you should be, expecting. The biggest one I would say that people are not so sure about is the land transfer tax, which can be substantial if, whether you're a first-time home buyer, you do get a credit on that. But even if you're an investor buying another property, as a principal residence, that land transfer tax can be anywhere from, we've seen $20,000 to $30,000 to $40,000. Okay, and that's not mandated by the bank. That's a government tax that you're going to have to pay, which the bank wouldn't tell you about. So make sure you speak to your solicitor about that before before your closing date, well before your closing date, so you can kind of provision for those things. And of course, there's a few other fees here that are tagged on that you have to be mindful of. If it's a condo, naturally there's going to be a condominium fee or a maintenance fee, as we'd like to call it, associated with it. You do have to pay for status certificates to make sure the property is in good standing, and then so on and so forth. So these are the standard fees. I mean, this really encompasses all of them. And again, not every single purchase that you make is going to have all of these fees. It's really dependent on the property type and the conditions surrounding that specific property. Okay, but again, you have access to this deck, so you can always reference this when you're buying your first house or second house, whatever the case may be. Okay.
So this is just kind of going off what Subin actually said. This is also why when lenders are qualifying you for a mortgage, apart from the down payment, they also want to see 1.5% of the property's value in closing costs. So you have the down payment and that's perfect, but they also want to see backup funds that you have 1.5% on average just to close the property. So kind of moving on to the process of actually arranging a mortgage. First thing you're going to be doing, and this is something that I'd urge all of you and whoever you think is looking to buy a property as well to do, is call us for a free mortgage eligibility. So this is a no obligation, no credit pull conversation that we're going to have, right? 15, 20 minutes at max. All this is going to do is help me gauge what your financial situation's at, right? Help me go over your credit, your income, your liabilities, as well as the down payment that you have. And based on these parameters, I can give you a very accurate representation or a very accurate number of what property you can actually go for and how much mortgage you can actually qualify for at what interest rate as well. So this is something that's entirely free. This is something that you can call your mortgage advisor for, and even me and Subin as well, right? 15, 20 minutes, like I said, and it makes a world of difference. After this, once we have kind of, put an offer on the property with the help of couple, obviously, we're going to be going towards the document gathering stage. So this is where, based on the type of mortgage we're going for, if this is a BFS mortgage, which is a business for self mortgage, for self-employed individuals, if this is a conventional mortgage, if this is an insured mortgage, based on the mortgage that we're actually applying for, I'm going to be asking you for a list of documents. And these can include every document from income documents to your CRA documents to your IDs and so on and so forth. From here, we go on to a lender pre-approval. Now, this is not a mandatory stage. A lot of people like to have a pre-approval for that peace of mind. But with how fast the interest rates are changing nowadays, I really think that this is a step that can completely be skipped in a lot of cases. I know a lot of builders require pre-approvals, and that's totally fine with us because we can apply for pre-approvals as well. But at the same time, this is a step that can be skipped because if you get a pre-approval today and you're buying a property next year, this pre-approval would not stand because pre-approvals are only valid for either 90 days or 120 days, which is 3 or 4 months.
We do have tools now.
For 1 year as well. But when the interest rates actually change up as well, right? At that time, you have to requalify, your mortgage anyways. So we have that option. If the interest rates do stay the same, definitely we can go for that. But in the case that they change up, which they are very rapidly, in that case, the pre-approval has to be requalified. We're also going to be looking at your firm approval after this, as well as condition fulfillment. What this basically means is when I submit your application and I say that, my client makes $100,000 for the year. Now, that's cool with the lender, and they're gonna, offer a conditional approval letter based on that information. But now it's my job to actually prove everything that I've said in the application. So just because I've said that you make $100,000 doesn't mean that we're done. This actually means that I have to provide the necessary documentation now to prove that you make $100,000. After this, we fulfill all the conditions. These can include fulfilling your income, fulfilling, your appraisal report, everything else. And after that, once all of our conditions are fulfilled, that is when the deal is instructed. The instructions go to your lawyer, and that's when the deal is closed. And the funds are first transferred to the lawyer's trust account, and then they're transferred to the seller or in your account if it's a refinance.
One thing I want to touch on, Swarv and I go through quite a bit in our side of things, is that every single approval that we issue is conditional, meaning that just because you got a mortgage commitment doesn't mean the deal is done yet. You have employment conditions to fulfill. You have down payment costs that you need to fulfill. So those things are things that the lenders want to see. They can ask you questions up until the very last day. On your closing day, they can come back to us and say, give us this documentation. Otherwise, we're not funding the deal. They won't forward the funds to the solicitor's office. So I think there's a stigma around it that, and we see this all the time, is that, oh, I got the approval. Like, why is the bank asking me for more documentation? Well, you got a conditional approval based on the fact that you will provide these conditions A to Z, and that's been fulfilled completely by the bank and their team over at the underwriting department. Okay, so important to have that in your mind is that this is conditional. It's not like a clean cut deal after that. We have to follow those steps to see you all the way through. Okay, so the process of arranging a mortgage, again, of course, you can always come and speak to us about that. We'll pre-approve you for a specific amount. You speak to your realtor to get the deal done on a purchase that you like. So with my clientele, they always call me first and say, hey, what am I pre-approved for? Whether it's a refinance or a purchase, they say, how much money can I pull out of my property based on the equity that I have, based on my income, or how much can I afford to buy, based on, all the liabilities and the income that I have. So we run an application. Granted, it may feel like we're asking a lot of questions, but honestly, sometimes, in the industry, you can feel like we're doing a colonoscopy on you. Sorry to put it in blunt terms, but we do ask for a lot of documentation. We do ask for pay stubs. We ask for, bank statements. We ask for CPP statements. We ask you for your credit bureaus. If you don't want us to pull it, you can provide it, and we'll use whatever liabilities that you give us, if we have that trust and relationship with the client. So it's a process, but it typically takes us about a half hour, maybe 20 minutes to load an application. And then we can tell you, hey, this is what you can afford, based on the numbers and the information that you've given us. So it can be a fairly quick process, given that we're pretty experienced in the field now. We know what to look for. It's just a matter of you reaching out and telling us, hey, this is what I have. These are my debts. And please be completely transparent with us on this process, because we don't want any last minute surprises when the lawyer pulls title and they see that you're on title for like your brother or sister's property. Well, now we have to include that as a debt, and your mortgage might not fund, right? So transparency is very important in our industry. We preach that and practice that quite frequently. Lender issues mortgage commitment, and of course, I've already touched on this point that it's conditional. Okay, so that's kind of a 1, 2, 3 process of how the mortgage would go.
So right after that, we're going to be reviewing the entire mortgage commitment. And this is where I send you for all my clients. There are no clients here, but if any of my clients were here, they tell you that I send a whole email with at least 1,000 words. This is all about the required conditions, because this is the meat and potatoes of the entire application, right? This is where, the deal is made or broken. This is exactly where we prove to the lender that everything we've identified and everything that we've claimed for you on the application is actually true. And there's proof of that, right? So this is where all the conditions are going to be there. For example, the proof of income, down payment, and all other required documentation. And once all the conditions are collected and all the documents are signed, we're going to forward these to the lender for a final review and approval. So Subin knows this. It's never a straightforward process, because we send these documents to the lender and they want more documents after. So it's not, once we ask for documents, it's not that we're done. We're probably going to send at least 2 or 3 more emails to you guys, to be honest. And we're sorry about that. But that's just the process. And lenders will be asking for more documentation. For example, if you send me a mortgage statement for yourself, for your other property, and it doesn't have your name on it, the lender has no way of identifying the fact that this is your mortgage statement. So they're going to be asking for another document, asking for proof of ownership. And if in that proof of ownership, there's another account that they see that they don't like, they're going to want proof of that account as well. So it just goes like that, right? Our job as mortgage agents is to make the entire thing as easy as we can for you, right? So we're going to be asking for the appropriate documentation from the get-go. And once all the conditions are actually approved, the lender instructs the solicitor. So the solicitor, just like the mortgage broker, has their own set of conditions that they have to fulfill. And once that's all done, that's when the file is actually closed.
Yeah, I think the one thing that, for Swarv and I that we work, most heavily on is that we try to make it as streamlined and as easy for you as the client or the realtor as possible by telling you, hey, this is what you can expect up front. You won't get any last minute surprises with us, because we know how this game goes. We've been doing it a long time. We've seen deals go south. We've seen, things that are basically unimaginable. Clients having to cough up $100,000, $200,000 at the office just to get a deal done. And we also know the horror stories of when clients go to brokers or agents who are not experienced, and they end up putting them on a private deal with a high interest rate of like 14%. And the clients are like, well, why the hell didn't you tell me this before? Now I'm stuck. I'm having to be in this crappy deal, right? So you won't get that with us. We'll tell you from the jump, this is what we can do. This is what we can't do. And 99% of the time we can do it. Is just, we're going to kind of have to drill you on that process first. Okay. So completing the conditions, once that's satisfied and we get that broker complete signal from the lender, those funds are going to be essentially, the instructions rather are going to be sent to the lawyer's office, whoever your lawyer is. It's always good to get in contact with a good lawyer. Of course, we have Amanda here for those things. And she's going to be doing the title searches, the liens, the RIT searches, land surveys, all of those things she'd take care of. And that's a bit of a process too. She may ask you for some additional documentation, but again, that's just kind of the legal side of things. Complete paperwork and signing with your lawyer. Once you sign a commitment with us, the last step would be to sign another commitment with your lawyer and a set of documents, disclosures to borrowers and things like that you'd sign with your lawyer. So it is a lot of paperwork, but you get copies of everything. And of course, we're here to kind of walk you through what you're signing. It's not like you're going to be blindly signing anything, okay? At the end of the day. So there's that.
So after all this, all the mortgage proceeds are actually advanced to the lawyer. So this is going to go in the lawyer's trust account, and the lawyer and your seller's lawyer will actually exchange on closing date the documents, funds, and register all the documents on title. And that's when you get the keys and you finally get to move to the property. And I know that we're kind of going over our time limit as well. I'm going to pass it over to Amanda very soon. But just to go over this very quickly, if you guys know anybody, or if you guys yourself are in this, if you are, a very recently graduated doctor, dentist, or vet, or if you are in medical school residency, psychologist too, exactly. If you are in residency in any of those programs, it doesn't matter what you make. You can make about $40,000, but we can actually get you qualified on a projected income of upwards of $380,000 in this case. So just because you're in your first year of med school residency, for example, and you're not making anything, doesn't mean you can't get qualified, because even then we can actually take an income of 190,000 just to qualify you. I've had a case of a client who actually came up to me and he made about $26,000 that whole year, and he wanted to get a refinance of $750,000 on his mortgage. And my first instinct was, this is when I was new to the industry, and my first instinct was, how are we going to qualify you? This is when I actually called up Subin, and he let me know about this, because this program is probably one of the best programs that we have. I actually qualified him at $160,000 because he was a recently graduated dentist. Right. So just because you're recently graduated, or if you're in that school situation where you're not making much money, doesn't mean you can't get qualified for a mortgage as well. Obviously business for self programs as well. Now, lenders do recognize that a lot of the income that you do make is not reported. It's not a true reflection of your financial status or your earning potential as well. So in this case, if you have, an IT professional or a truck driver, for example, they could be making about $160,000, $170,000. But with all the write-offs on your T1 general, I see about $60,000, which kills the deal, right? These lenders are actually not going to be interested in your CRA documentation whatsoever. They're actually going to be looking at 6 to 12 months of your business bank statements. So this is important because I get to sit down with the client, or Subin gets to sit down with the client, understand their business in and out, look at all the overhead expenses, look at all of the things that can actually be set off against that income, and kind of declare an income. This is why it's called a self-declared income form. That's the form on which we declare the income. We note down all the expenses that you guys may have. And, it's very self-explanatory, but the expenses for a truck driver are going to be much different than the expenses for a convenience store operator. A person who owns a convenience store is going to have a lot of expenses, cost of goods sold, overheads, employee costs, everything. A truck driver may have insurance expenses. If they own the truck, there's going to be lease and all those things, but it's going to be nowhere compared to what a convenience store owner is going to have, right? So we just have to sit down with you, understand that business in and out, and that's where the expertise of a mortgage agent does come in.
We love business for self. We love business for self clientele. If you're a hairstylist, a DJ, or you're a social media influencer, right? We've done deals for all of these people across the board, whether they're complicated or not. I think if you're a competent business owner, you're going to have some business bank statements to show, and 6 months is all it takes, right? That we can utilize that, multiply it times 2, and annualize that income, and be able to use that with a couple invoices. Very, very simple process versus you going to a Schedule A bank and they're asking you for CRA documents, they're asking you for notice of assessment, T1 generals, things that you might not even be aware of that I'm talking about. They're going to ask you for that. Corporate T2s, right? All of those things they ask for. So we love BFS because we're able to get all of those deals done. Even if they're not showing much on their business bank statements, we can take a cash component and we can still get you qualified with minimal income. So we have a beautiful plethora of programs for those types of clients. And we get a lot of those done. We do pride ourselves on that aspect of the business. Now the HELOC, that's for existing homeowners. If you have an existing house with an existing mortgage on it, clients want to tap into the equity. If you signed your mortgage, let's say 2-3 years ago, and you're getting a good rate of like 4%, you don't want to break that term right now because you're going to have to be paying upwards of 7-8% right now in the current market. We can just put a HELOC in second position behind that mortgage without having to touch it. So you can get your $100,000-$200,000 for, your kid's education or investment purposes or whatever you want to use it for, whatever the hell it is you want to use it for. We can get you that money without touching your mortgage. Your mortgage is intact. We have products for that where you can utilize it as a MasterCard, or a credit card. You use it for home renovations, things like that, and your mortgage is still intact. We call it a home equity line of credit or home equity line visa, different terminology for it, but we have a few lenders that offer that product, and it's very good. If you are already in a term where you don't want to touch your mortgage and go through the BS of having to re-register and provide all your documentation again, it's there, it's set, it's untouched, and we just put a charge behind it, and you can utilize that as you please. You only get charged for the amount amount that you use. So if you're going to take out a 200K HELOC and you use 100,000, you're only paying interest on the 100,000 versus the 200, which is what you would get if you were getting a private second or something like that. Okay, moving on. So some of the lenders here, everyone that we have, these are the alternative ones that we have been, consistently speaking about. Community trust, a flexible alternative is their solution because they're an alternative lender. Equitable bank, home trust company. These are all lenders that, we can go over that total debt service ratio of 44% that we were talking about. We can go over 50%. We can even go over 60% total debt service ratio. Okay, so it doesn't matter what your situation is, as long as you come to the table with at least 30% down payment on your property, we can get you qualified for a mortgage, even if your ratios are through the roof, right? So, I mean, I'll let Sar talk a little bit more about those ones.
So with these lenders, obviously, we have way more than just these, right? I know our little screen is blocking it, but there's First National as well. They're another lender that specializes in extremely good service, and they have flexible options that I recommend to pretty much all of my clients. Because in this day and age, to be honest, and Subin's going to attest to this as well, it's very, very hard to actually qualify somebody with a bank, right? Just to fit somebody within those 3944 parameters is next to impossible, right? And this is where these lenders come in because, for example, just home trust and community trust, obviously the terms and conditions obviously apply, but these lenders can actually go up to 60-60 GDS and TDS. First National, for example, can even go up to 50-50. Equitable can go up to 48, right? There's a lot of these products that we do have, right? And this is where, all these alternative lenders actually come into play because where the banks say no, these guys actually say yes.
And the one thing I want to for all of you to find is that you would be going with a community mortgage solution to acquire that because we have access to certain programs and other. We've been doing this a long time. We're getting response times. And we of course we have designated underwriters that work exclusively with our team. That if you were to go to another brokerage somewhere else, you wouldn't be getting that same level of service, right? So that's why you'd be working with us. It's a big plus point for you when you're looking to purchase a home or order refinance. So documents required, again, this is kind of a tidbit of what we'd need from you just to kind of get you qualified. Of course, the IDs to register you, property tax statements, mortgage statements for employed people, your most recent 2 pay stubs, your T4s, and if you're self-employed, 6 months bank statements. For some of you, this might be familiar if you've already done a mortgage or you have a mortgage right now. You might say, okay, yeah, they've asked me for T4s before. They've asked me for these documents before. Again, it's very standard practice. But if you're able to kind of review this in advance, and this is why you're here today, if you know what your mortgage person is going to be expecting from you, have this ready for them. So that way it kind of makes the process go smoother. That way we can kind of get you pre-qualified or a full approval without many conditions on the table. Self-employed people, obviously, there's a bit more to that. It's not just the 6 months bank statements. Of course, we'd require some invoices, and some additional trucking logs if you're a trucker, or certain receipts if you're depending on the industry that you're in. But this is kind of the nuts and bolts of what we would be signing for or asking for. And then, of course, we're not going to pull your credit without the credit consent form. Everything we do is by the book because it's all logged in our system. So we're very straightforward, very cookie cutter when it comes to documentation. And of course, we can play around with it on the back end if we need to, but this is essentially the gist of it.
So with that, I think Subin pretty much covered it all, and I'm gonna pass it on to Amanda.
Perfect. So now your mortgage is approved and you found your dream home. So now the best part is you get to come and see me, and I'm going to take you through the final stages of becoming a homeowner. Okay. So the first thing is, how are you going to be taking title to the property? So there's 2 parts, okay? One is joint tenants. And the second one is basically tenants in common. So if it's joint tenants, that basically means that your share is split. So it's 50-50. So it's equal. So let's say if one person were to pass away, your share automatically goes to the next person. So this is called the right of survivorship. So most people use joint tenants. Let's say if you're a married couple and you're trying to buy a matrimonial home, then you'll use joint tenants because it's just easy for estate planning. Okay, the next one is basically tenants in common. So with tenants in common, your percentages are going to be different, but they all have to equal 100%. So if one person were to pass away, your share doesn't go to the next person, but it basically forms as a part of your will or your estate. So for example, we have Brandon, Jessica, and Dylan. And Brandon has 40%, Dylan has 40%, and Jessica has 20%. So it all equals 100%. So let's say if something happens to Brandon, his share does not go to Jessica or Dylan. His share will form a part of his will. So people use tenants in common. Let's say if you're an unmarried buyer, let's say if you're business partners and you're trying to buy something for investment purposes, or let's say if you're children of a cottage and you're inheriting a property from somebody. Okay. The next one is non-resident speculation tax. So this is a tax that applies if you are not a permanent resident or citizen of Canada. So basically the tax is 25% of your purchase price. So let's say your purchase price is 700,000, then the NRST payable is going to be 175. So it basically applies to every single type of property, from detached homes, semi-detached, or to townhouses. Okay. Then you're going to have to get home insurance. So this is mandatory. So what will happen is the mortgage agents are going to send us your mortgage instructions. And in that mortgage commitment, there is going to be the name of the bank. So for example, TD. And under TD, it's going to say a specific address. So it'll say 4720 Tahoe Boulevard, 5th floor. So when you get home insurance, you have to get home insurance with that specific address and that specific lender. It's not where you went and you signed the documents. Okay. Next is title searches. So part of my job is basically to make sure that when you buy the property, there's no debts, no liens or charges. A charge is basically a mortgage on title. So basically this search has to be done by a set date. And that date is going to be in your agreement of purchase and sale, and it's called the requisition date. So basically, the purchaser's lawyer, they send like a letter, it's called like a requisition, which basically means to remedy. And they have to send this to the seller's lawyer to basically fix these issues before closing. So that way, when it comes time to closing, you have clear title. So no debts, no liens, no mortgages on title. There are certain things that are permitted. They're called permitted encumbrances. So let's say you have like a Bell utility line that runs through the land. So something like that is permitted. So let's say if Bell wants to come access your property to fix something, they're allowed to do so. It doesn't affect your ownership of the land, but it's something that we can't remove off title. Perfect. Next is the mortgage. Okay, so basically with the mortgage, so I'm going to get the mortgage instructions from your mortgage agent, and I'm also going to take a look at the commitment. I'm going to make sure that if there's any conditions. So let's say, for example, one condition is that you have to pay off your student loan. So I will ask you maybe for like a bank statement showing that your student loan has been paid off. And then we also have to submit this to the bank. Sometimes it's done before closing, sometimes it's done after closing. It's called like a final report. Next, you'll be asked to bring a bank draft. It's going to be made payable to our law firm and trust. It'll include the balance down payment and the closing costs. Okay, for the final stages, you're almost there. So you're going to meet with me. You're going to provide the bank draft. I'm going to go over all of the documents with you. Okay, they're just called the closing documents. And then what will happen is we do the registration. Closer to around 5 p.m., we'll give you a call. We'll let you know the property is yours and the keys will be at the lockbox at the property. So we'll tell you the code, and that's how you get the keys. And then a couple of days, you'll come see us again, and we'll give you a final package, and it will include all of the documents that you signed. Perfect. Next is a land transfer tax. So this is something that you can't avoid. So when you buy a property, you have to pay land transfer tax. And that tax is basically payable on the value of your purchase price. So let's say your property is 400,000, then basically the land transfer tax payable will be 2% of that. Next is title insurance. So title insurance, it's basically a policy that protects against fraud. Okay, go back one step. Okay, perfect. Okay, so title insurance is a one-time fee that you'll pay. It's basically a policy that protects against fraud. So let's say someone puts a fraudulent mortgage on your house, or let's say the previous owners maybe didn't pay for the utility bills. Title insurance will protect against that. It will last up until you decide to sell this house. It's a mandatory thing that you have to buy. So there's three types of title insurance. So one is like a lawyer's opinion on title insurance. But the thing with the lawyer's opinion on title insurance is that it doesn't protect against any post-closing issues. So let's say you move into the property and then you get a bill from the previous owners, the lawyer's opinion won't be able to protect you against that. Next is basically traditional title insurance that will protect you against post-closing issues. So our firm uses title insurance from a company called First Canadian Title. There's other companies as well. Okay. The third one is Title Plus. So that's like a combination. So it's a mix of traditional title insurance and also there's protection for the lawyer. So let's say if the lawyer makes an error or omission, the lawyer is also protected. But most law firms, we use a traditional title insurance. Okay. When we buy title insurance, we also have to buy lender title insurance. So lender title insurance also protects the lender, so also known as the bank. So let's say if there's any defect or affecting the title, the lender is also protected. So that's included in the one-time fee that you'll pay. Okay. Next, so title insurance. So title insurance protects against fraudulent mortgages, unpaid utility bills. It does not protect against theft, water damage, fire. That's why you need to get home insurance, okay? It also does not protect, let's say, wear and tear of the home. Or if you did renovations and the renovations didn't go well, title insurance will not protect against that. Then you have other closing costs. So to register the mortgage and the deed, it's $82 per mortgage and per deed. So a total of $164. That's a standard government fee. You can't avoid that. Then to do title searches, so we do a search on the property to make sure everything is clean. So no debts, no liens on title. That's $169.50. Okay. Then there's a software fee. So our firm uses a program called Unity, and every law firm has a software. So that fee is $281.37, and that fee goes directly to that program. And then lastly is basically like the legal fee. So $600 for the transfer of title, and then $350 to review the mortgage and to register. So a total of $950 plus HST. And then lastly, everyone has disbursements. So that includes like photocopies, couriers, banking fees. That's around $80. Okay, now for the best part. So if you're a first-time home buyer, you get a rebate. So in order to qualify for the rebate, there's certain conditions that you have to meet. So the first one is you have to be 18 years of age. Second one is you can't own a property anywhere else in the world. This has to be your first property. The third one is, let's say if you're a married couple and let's say one person bought a house before, the second person who's never used, so the other spouse who's never used that rebate is not entitled to the rebate. So if one person has used it, then you're both not entitled
unless the person who used that rebate basically sold that house before they got married. Okay? So I know it might be a bit confusing, so I'll go over an example. So let's say Jess bought a house with her brother Justin in 2019. And then Jess then met Brandon, the love of her life, in 2020. And then afterwards, Jess and her brother sold that home in 2021 because the interest rates were too high. In 2022, Jess and Brandon get married at a nice ceremony in Mexico. A few months later, they find their dream home. So when it comes time for their closing, Brandon is entitled to the rebate because Jess sold the property with her brother before she got married. Okay. So if you're a first-time home buyer, this will reduce the amount of land transfer taxes payable. So let's say for some reason you don't claim the rebate at the time of closing. Maybe you decide that this is going to be your investment property. And then when it comes time to closing, you've actually decided that you want to move into the property. That's no problem. What you can do is you can apply to the Ministry of Finance. We'll give you the supporting documents as well, and you can basically claim that rebate back. So there's two types of rebates that you're entitled to. Okay? So the first one is basically the provincial rebate. So for that one, you are basically entitled to a maximum of $4,000. Okay. If it's also a municipal rebate, so if the property is in Toronto, you're entitled to a maximum rebate of $4,475. So let's say if you're buying a property in Toronto, so this includes North York, Etobicoke, or Scarborough, you're entitled to two rebates. So the first one is a provincial one of the maximum 4,000. The second one is municipal for a maximum of 4,475 for a total of 8,475. So let's do an example. So you're buying a property in Scarborough, it's 500,000. You're a first-time home buyer. So if you weren't a first-time home buyer, the total rebate you would be paying would be 12,950, which is a lot. But if you are a first-time home buyer and the property is in Toronto, you're entitled to two rebates. So the first one, the 4,000, which is a provincial, and the municipal, which is 4,475. So the total rebate would be 8,475. So you deduct 12,950 from 8,475, and the land transfer tax you're payable now is 4,475 versus 12,950 if you are not a first-time home buyer. Okay, so in order to be a first-time home buyer, you have to be a permanent resident or a citizen of Canada. So let's say at the time of closing, you are not. That's okay. From the time you become a title owner, you have 18 months to apply for the rebate. So if you become a permanent resident or citizen of Canada within the 18 months, then you can apply to the Ministry of Finance and you can get that rebate back. So I know that was a lot of information. And so if you have any questions, my contact details will be shared at the end.
I know there may be quite a few questions, but I think we'll start with the online questions first, get through those, and then, we'll be happy to answer anyone else's questions here. So first question we have is no, can't see you. That is not a question. Yeah, they can see us. It's fine. Feel free. Yeah, please. Mm-hmm. 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 Yeah, great question. When you pull the bureau, the system automatically takes a certain calculation, which might reflect as the minimum payment. Now, the rule of thumb for credit cards is 3% on the balance. If it's a line of credit, we take I think it's the Bank of Canada prime rate, amortized over 25 years on the balance, and we take that as the payment. Now, whether you've utilized your full line of credit or not, most banks, especially Schedule A, will take the full balance. So let's say you have a line of credit of like 40,000 with a 100K limit. They'll take 100K, max it out just because it's a surety for them that you won't overutilize, right? When it comes to credit cards, it's that 3% rule of thumb. Okay, so most of the times the credit bureau that you pull should be accurate, but in case it's not and it's reflecting like a smaller payment, the lenders will do the work on that. But the rule of thumb is 3%. Good, Swar, we covered. Yeah, good question though. Yeah, Shane.
So no.
Yeah, definitely. Like this is more so for someone who's an existing homeowner. If you have a secured line of credit, this is where they max it out, right? But you won't get a secured loan for a small amount. It's going to be, anywhere from 50K and up to almost $2 million that you could get secured on a line of credit. So if you just have a dormant line of credit that you have against your property and it's 100 grand, well, guess what? TD's going to say we're maxing out the entire thing and taking the payment on that because you could utilize that after the fact and then they wouldn't know about it, right? So naturally for them as an insurance policy, they take that into consideration before they approve you for anything. So if you fall within that guideline, hey, you're great. If not, it can be tricky, but that's something that we can definitely work around. If you come with us, our brokerage especially, we're able to get those exceptions made and say, hey, listen, don't take it into consideration. It's not that easy, but we can say, don't take it into consideration. We can offset it with something else. And, generally they're willing to work with us on those certain things. Okay. Or there's other lenders that we can go to. It doesn't have to be just that one lender that says, hey, we're maxing it out. No, not the case. We can go elsewhere if need be. Okay. Great question. Yeah. Oh, yeah.
Yeah, you were saying during the presentation, I know, like there's during closing, there's always like surprise, right? Like,
Yeah.
You said one was that was closing, but he had a sister.
Yeah. Yeah.
I was wondering, like, you guys mortgage different perspective, mortgage lawyer, realtor. Like, I know closing date could be a suspected date.
Yeah. Yeah. You're a homeowner, I'm assuming, right?
Yeah, homeowner and realtor too as well.
Okay.
Just like in terms of like, just like it's crazy. Like, there's always things, right?
Yeah. Yeah. Yeah.
Some people are not fully transparent and hear about it at the closing day.
Yeah. No, absolutely. I mean, that's why we go through everything with you thoroughly before the day of. So you said that you mentioned if you're entitled with someone else, that's something that you want to disclose to us because sometimes we pull a bureau and that property may not show up. But if we do a title search or something, it can come up. But that's up to the client to give us full transparency on because we won't know unless you tell us what the situation is, right? I just closed the deal. Yeah, no, it's not intentional, and we're not blaming the clients for it. We're just saying, let us know. So we had a deal where it was a brother and sister, both on title for two separate properties, right? Now we didn't get that information to us because if you're on title for, let's say you have a rental property, and you're on title for that with your sibling or parent or someone who's not on this specific deal. Now we take rental income to offset the mortgage on that, but now we can only use half because there's an ownership dispute, right? Even if it's 50-50, or let's just say 99-1, a lot of times they'll take half the rental income and the full liability, right? So it's not a case of, oh, I thought the bank would just take half the liability if I'm, 50-50 split. No, not the case. They'll take half the rental income, but they'll take the full mortgage amount. They'll take the full property tax on that, full heating, $100 a month, right? So that's something that can, if we don't know about that, they're going to scale back the loan amount and say, hey, they don't qualify for this much. Then the client has to come up with the shortfall because they didn't disclose that information. Now, again, it is our duty to ask those questions, of course, ahead of time. But if that situation does arise, know who you're on title with for what, and let us know, hey, this person's on this property with me, or that person's on title for another property. This is how much ownership stake I have. This, that, and the third. It's definitely important to disclose those things, right?
Why did they take the full?
It's a surety thing for the bank. Unfortunately, we don't make that rule. In that particular case, the brother had 99% ownership, sister had 1%. So we were able to make an exception just because it was on paper and it was legalized. But that often does not happen. That's not the case. They won't look past that. They'll say, no, this is how it is. It's unfortunately, it's just a guideline that's kind of set across the board.
Yeah, I think it's at least the way that's done it before. Is that what happens if you don't or you leaves for whatever reason, or something happens to them, or they lose your job, and they're not able to pay the rent. The half rent is the kind of way for them to assure that there's still some way for you to afford taking on.
Yeah.
And correct me if I'm wrong, even if it's your own basement for your home, they still assume 50% the rent. They don't assume full 1%.
It's okay. I'll let you answer this. Case by case basis on the rental, right?
Yeah. It's all case by case on the rental income, right? Like we mentioned with rental income, there's offsets, there's add backs, there's everything, right? And depending on what type of lender we're actually dealing with, right? A lot of lenders would actually do an add back, which basically means, say your rental income for the month is $3,000. If the rental add back is 50%, that basically means I add $1,500 to your income every single month, right? So that's 1,500 times 12, right? That's going to be $18,000. That 18,000 is actually added to your annual income. Now, in the case of an offset, however, what happens is that $18,000, if it's a 50% offset, that $18,000 is offsetted against your liabilities, which helps our ratios a whole lot. Think about it this way, right? If your income is $100,000 and your expenses are $50,000, that means your TDS is at 50% right now. If we did the add back approach, that means your income is going to be 118,500 while your expenses stay at 50,000. It's going to help our ratios, but not too much. But now look at it this way. If we do an offset, your expenses actually go down to $32,000. So now your TDS is 32% instead of 50%, which basically means you can get qualified with pretty much every lender that's out there, right? So an offset and add back are the two major approaches that we deal with. We also have rental worksheets, but they have their own way of kind of calculating things and dealing with things. But in all the cases, an offset is generally the more viable option for the clients, for sure.
I think that's kind of difficult to understand, but that's kind of for us to know. And again, we try to squeeze as much out of it as we possibly can, given exceptions and things like that. Joshua, you had one question? Mhm.
Yeah. Yeah. So basically, once you've accessed that, you've used that right, so you've bought your home, you can't use it again. So it doesn't matter if you become a homeowner in another like 4 years. Once you use it, it's done. But I was reading like basically if you're trying to open up, like you have an RSP account and you take out that money, then afterwards, I'm not too sure, you might want to speak to the bank, but then if you take out that money the first time, it's tax deferred. And then let's say you wait another 4 years, then you can take out that money again. So I think it applies, and people are talking about that. I think it refers to like the first time home buyer plans, but not about the rebate. The rebate is only a one time.
I think we have one more
Yeah.
related question. So what if I want to pay things off before my mortgage closing? So that's a great question because just because you have a lot of expenses or unsecured lines of credit or credit cards doesn't mean that you can't pay them off before you're closing to help your ratios, right? So say if you have monthly expenses of about $3,000 in unsecured lines, in credit cards, in a student loan, whatever it is, if you have some extra cash laying around, you can definitely pay those off before your mortgage closing, which can actually help your ratios a whole lot. In the case of a refinance now, because you actually get money tapping into the equity of your property, say if you get an additional $200,000, right, on your mortgage, all that basically can be done in that case is instead of paying all these things prior to closing, I can actually indicate that these things can be paid off from proceeds. So a lot of people actually do this. They consolidate their debt through a refinance because no matter how high their mortgage rates are right now, they're nowhere nearly as high as the interest rates on a credit card, for example, right? We're looking at upwards of 20% in that case. So what a lot of people do if they have a lot of debt, and one of my clients is actually doing this as well, they're actually arranging a mortgage from a B lender. They're getting an additional $200,000 and they have debt of about 150. They're going to pay all that debt off, consolidate everything into one huge mortgage of 7%, and that helps their cash flow situation a whole lot. Right. So definitely you can pay things off before your mortgage closing. But in the case of a refinance, I can also indicate that these things will be paid off from proceeds. And that's where the lawyer comes in, because at the lawyer's office, these things will be paid off just to ensure and have proof that everything has been facilitated properly and whatever we've indicated on the mortgage application has been carried out at the lawyer's office as well. Any other questions from you guys? Yeah, go ahead. Mm-hmm.
Just with mention mortgage, at least how many years of experience
That's a pretty good question. So honestly, in most cases, if you've just joined an industry, right, that's something that we have to take an exception on. Because, for example, if you were working in, finance, for example, and you suddenly switch to IT, yeah, that's something that's definitely going to be questioned, right? Where'd you get the certifications from? Where'd you get the education from to be able to switch that, right? But for example, if you've been working in IT for the last 4 years and you just switched to a new role about 20 days ago, even though you're on probation, that's much more easy to explain to the banks because you've been in the same industry for a very long time, right? And industry change and a job change are very different. If it's a job change, it's very easy to explain. If it is an industry change, we kind of need more of a backstory on what kind of prompted you to make that change, right? But in most cases, if it is also variable income, if are getting bonuses or overtime, we need a record of the last 2 years of your T4 and take the average of that to qualify your income as well. So if you have that variable income, that overtime component, last 2 years of T4s, and if you have changed your job, all we have to do is get an exception from the lender, and they can, in most cases, they do grant it. Yeah, for sure. 3 months, yeah. 3 months probation. I've even had a client who was on a 9-month probation. Me and a couple were actually working on a deal together. He just switched into his job. So I submitted his application back in June. His closing was in September, but he was switching to his new job in August. So at the time that I actually submitted his application, he was still at his old position and he hadn't even switched yet. And he was going to be on probation at the new job for 9 months, but we still got the deal done, no problems. Just because it was the same industry, if that makes sense.
With the question you asked, like just about work experience, it's actually a pretty common question, especially among younger people, because if you've just joined a new job, but let's say either your parents have a large amount of cash to be able to provide to you to invest or to buy your home, or perhaps you were really good with your money and you've been saving since uni or from college, and you want to get into real estate, well, this is where pre-construction can provide a huge advantage, especially now with the whole extended deposit structure that a lot of builders are able to provide. It's where, let's say you're looking at a townhouse or detached home, semi-detached, and even if it's further away, if it's for an investment, you want to rent it out, you're able to kind of book that property and it'll finish in about 2 years. And by that point, you will have built up that job experience. You may have even moved to a new job, but you basically have more cash on hand and you have the experience to show the bank. So that's where pre-construction has a huge advantage. If you talk about condos and they're finishing 6 or 7 years into the future, that's you're for sure going to have a lot more work experience at that point. And the best part about pre-construction is you don't have to worry about your mortgage until closing. So because of that, it's a lot easier, especially for younger people, to book pre-construction condos. Let's say you're really young or you're just married and you're not even ready to plan for a family, but you know it's going to happen. Well, you can book a 2-bedroom condo now, and in 8 years, when you actually begin to take those bigger steps, it's already done and the condo's already been built, and you bought it at a price that was available 8 years ago. So you've kind of won in two ways. Not only have you planned for the future, but you've also built equity, or you've appreciated the property is appreciated over the years to also help you out. So it's kind of a win-win situation, especially for younger people. And when you close, you get the first-time home buyer rebate. So there's a lot of benefits you get when you plan ahead, especially when you're younger. Yeah. Any other questions online? Yeah. You know what? All four of us are going to be available whenever you have any questions. We'd be more than happy to sit down with any of you to address any specific concerns you may have. For the ones in person, please feel free to grab any more snacks while you're here. But yeah, we're going to be here. We're going to chat if you guys want to talk about anything. But thank you to everyone for attending online and in person.